This video is looking at task 4 of DAIF, which is the Drafting and Interpreting Financial Statements Level 4 unit. And it's firework night. So lots of background noise. Right, let me share my screen. So task 4. So again, you do have reference material here for task 4 in the side panel, same as we had for task 1 and 2. This task is all about international accounting standards, and it includes an element of writing for a couple of matters, matter 1 and 2, and then it has 2 multiple choice or tick box computer mark type questions. 12 marks altogether. So Buzz Limited is a manufacturer of electrical appliances. The finance director is preparing the financial statements for the year to 31st of December and has brought the following matters to your attention. Matter 1. A legal action was brought against Buzz Limited in November, during our year, by a former employee who is claiming compensation of £50,000 for unfair dismissal. Buzz Limited solicitors have advised there is a 30% chance that the claim will be successful. Right, so as a rule of thumb, to be probable, we're looking at more than 50%, and that would make it a provision. If it's possible, under 50%, as we have here, then that will make it a contingent liability. So the definition of a contingent liability is a possible obligation from past events. So, pardon me, let's look at matter 1, what we've got to answer. Identify whether the legal action should be treated as a provision or a contingent liability. So 1 mark, we know it's a contingent liability because it's possible, not probable. So state 1 reason for your answer. So I'm going to say a contingent liability is a possible obligation from past events, whereas a provision would be probable. All right, so that should get me 1 mark. State the accounting treatment of this matter in the financial statements. So I know that when I've got a contingent liability, so let's just work back. If it's certain, it's a liability. If it's probable, it's a provision, and we adjust the account, we provide for it. If it's only possible and it's a liability, we have to disclose. So the possible compensation should be disclosed as a note in the accounts. 1 mark. Right, that's it for that one. So I'm now going back to matter 2. So I can see straight away this is about leasing. So on the 1st of January X1, Buzz Limited entered into a lease for a machine. The company was required to pay an initial deposit of £600. So just thinking about that, the double entry would be debit the right of use asset, credit bank, the amount of the deposit, followed by 3 annual instalments of £3,000 each, starting on the 31st of December. So this is being paid in arrears at the end of the year. On the 1st of January X1, so that's right at the beginning, the present value of the lease payments is 8325. So the present value basically means the £9,000 that we're going to pay all together, 3 times 3,000, that's the actual amount of the future payments. they have been discounted into today's prices. That's what we mean by the present value. So 8325 is the 9,000 at today's prices, and it's this figure that we're interested in when we are recognizing the asset at the beginning. So we would go debit the right of use asset with 8325 and credit the lease liability. So at that point, the value of my asset is going to be the 600 that I paid up front plus the 8325. And the lease liability that I will be showing in the accounts will be the 8325. Machine has a useful life of 5 years. So we've got a 3-year lease, machine useful life of 5 years. So the number of years that we need to depreciate this lease over depends on whether or not ownership transfers at the end of the lease. So look at this bottom bit. Ownership of the asset does not transfer to Buzz Limited. So in that case, we need to depreciate over the 3 years. If it had said it does transfer, then we would have depreciated over the 5 years. Right, so my depreciation amount is going to be the value of my asset. So we've said that the asset is the 600 plus the 8325, which is 8,925, divide by the 3 years. All right, so that gives me a depreciation figure of 5,000, no, sorry, depreciation figure of 2,975. All right, so just to repeat, it's the total value of the asset, 8,925, divided by 3, which gives me depreciation for the year of 2,975. The value of interest implicit in the lease is 4%. That's just explaining the difference between what I'm actually paying and the present value at the beginning. Right, so kind of thought about what's going on there. So let's see what the question asks. Calculate the amount at which the machine should be recognized as a non-current asset in the statement of financial position. Right, so we have said machine should be recognized as a right of use asset with a value of, we said 8,925. Let's show the examiner that that's made up of the £600 deposit plus the 8,325 present value of the lease payments. Right, so that should get me the 2 marks comfortably. Explain your answer above. I've kind of explained it there, haven't I? So I'm going to say, oh, hang on a minute, have I fully answered that? Let's just think. Calculate the amount at which the machine should be recognised as a non-current asset. Right, okay, so I'm just going to backtrack slightly. What I've written there will be how much the machine will be valued at to begin with. This question is asking me at the end of the year, so I'm going to have to bring in the depreciation. So the machine should be recognised as a right of use asset with a value of 8,925. I'm going to put initially. It will then be depreciated by, now what did we say? We're going to do it over 3 years. So that comes to 2,975, which is the 8,925 divided by 3. So therefore, the carrying value at 31st of December 20x1 is 5 950, and we could show the examiner that that's the 8925 subtract the 2975 for the accumulated depreciation. Now, I've probably done too much there. If I look at their answer, it just says the machine should be recognised at 8925 brackets 8325 plus 600 minus 2975, and they've shown that working in brackets, which is therefore 5950. I've written a little bit more than their answer, but I think I've just broken it down and really clearly shown that I know what I'm talking about, hopefully. So then in part 2, it says explain your answer. So we need to say here, the machine is initially recognised at 8925 as a right of use asset. This figure is the initial deposit paid plus the present value of the lease payments. The machine is depreciated over 3 years because ownership is not transferred at the end of the lease, and therefore we depreciate over the lower of the lease term and the life of the asset. Okay, so again, looking at their suggested answer, it basically says that, but it also says any other relevant points may be awarded marks. So the people marking this do, they are able to use their discretion. We go on. Trunk Limited provides gardening services. The company has entered into a 12-month contract for regular garden maintenance work, commencing on the 1st of July. The agreed contract price is £5,000. Right, so if we were just to stop reading there, we might be forgiven for thinking, well, where's our year end? December. So we might think, well, okay, we've done 7/12 of the work. No, sorry, 6/12 of the work. We've done half of the work, which would be £2,500, which is one of the suggested answers. But we go on, at the 31st of December X1, they estimate it has completed 40% of the work required. So the fact that they've only done 40% of the work is going to override the fact that 6 months or half of the time has passed, because what we have to do with revenue is match it to the work that is being done, the contractual obligation for the revenue being received. So actually that 40% is more important than the number of months that have passed. So we're going to do 40% of 5,000, which gives us an answer of £2,000. Right, then we come on to part D. So this is about impairment. This is the last one in this task. So it's asking us, have these 3 assets been impaired or not? So impairment compares the carrying amount with the recoverable amount, and the recoverable amount is the higher of the fair value, less cost of disposal, and the value in use. Right, so for asset A, the recoverable amount will be the 14,000 because it's higher than the 11,000. The carrying amount is 12,000, which is lower than the value in use. So therefore, asset A is not impaired. Asset B, we compare the fair value and the value in use, and we've got a recoverable amount of 7,000. At the moment, this asset is carrying at 9,000, so it does have to be impaired by that down to that 7,000. So yes, asset B is impaired. Finally, asset C, we've got a recoverable amount of 15,000, which is higher than the carrying amount. So asset C is not impaired.